Okay, good morning, everybody. Let me turn this rock and roll music off. I can't find what window it's in. There it is. All right, let's get on with it. Hang on, I gotta hide that page. I gotta find where we are. There we are. Hey, all right. So, welcome to QuantBox Live. Let me pull up the site. QuantBox Live. It is 6:36. Sorry for the tardiness today. Just got too much going on. Anyways, welcome to QuantBox Live, where we uncover the best fundamental opportunities across the global markets. Our AI driven data analysis of sentiment, inflation, GDP, employment, technical trends, open trade positioning, and seasonality uncover the best fundamental investment opportunities. Now, we also track market, not just economics, but market forces. Anyways, my name is Wayne McDonald. I'm the founder. I'm also a Harvard trained economist. I've been trading and investing professionally for just over 20 years. Yeah, I love trends, and trends are based on the fundamentals. As you can see, we drill down into the fundamentals. Very cool. So, if you're watching this live stream on YouTube, you're watching it several hours delayed. Why don't you consider swinging by quantbox.co? Take a week trial for less than $8. You just might fall in love with it. I don't think it'll marginally improve your trading. I think it'll radically change the way you trade. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Let me log in. Coolio. So it must be Thursday, the 27th, since this is the most recent video. So, welcome to Thursday. We had a little Fed meeting yesterday. And did we learn anything new? I don't know. Not really. So now the rest of the world, aka the market, is a little messed up because they got the one interest rate decision that we all agreed upon. Um, but now they're not so sure about the future. Well, I'll tell you for certain. The Fed has told us there's one more. So the market has to figure that out. I mean, figure it out. We've known this for 6 weeks. So, anyways, okay. So now the market's got to figure it out, and that's danger for us. That's danger for us because you could have straightforward economics, and yet the market is indecisive or potentially even wrong. So you got to wait. Nonetheless, right now the markets are mixed. Everything's neutral, scatter plots all over the place. Although, wait, no, I know that we were doing some back office work. These are not neutral. You can see there's still negative threes and plus sevens. All right, so I got to send them a screenshot. Okay, that's not working properly. Okay, so anyways, the scores are still proper. So this should be, very bullish, 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 and so on and so forth. All right, well, I'll have to screenshot that. 10-year T notes still at 3.85. Oil trying for 80 again. Gold back towards 2000. S&P 500 trying to make those higher highs, huh? Euro dollar up 0.55. Okay. Bitcoin up 1%, but it's still solidly below 30, the big psych level we've been tickling. So remember, yesterday this was 29,000 even. Now it's up $500. Not dramatic moves. see if anything's changed on the longer run. Yeah, risk on. The market's playing it like the Fed is done. That may or may not be true. Doesn't matter what we think should be right. When we look at the at gold, 10-year T-note yields, S&P 500, yen futures, dollar index, and the VIX, we're just ever so slightly bullish now on the weekly and monthly expectations. Ever so bullish. Not crazy bullish, just barely bullish, but bullish nonetheless. Excuse me. Before the Fed meeting, weekly bias was slightly bearish. So yesterday's news made these other assets move in such a way that you believe that there's risk on. Cool. So that is a meaningful change. We don't need that right now. I'll just point this out one more time. I know you know it, but still. So, based on what the Fed has told us, let me zoom in here. Based on what the Fed has told us, we have interest rates going up to this level, up a little higher. So, one more rate hike. This is yesterday's hike. Okay. This hasn't updated. You're like, wait, how come you haven't updated it? Don't you? Whoa, 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 settle down. This data comes from the summary of economic projections, which is not updated until the next meeting. So, anyways, so this is the hike that was um, yesterday. There's one more hike, then there's a pause, then there's a pause, and there's a cut. So the market's trying to figure it out. Is there going to be another raise? Well, they told us 6 weeks ago that there would be. So it's really quite something when you're depending on other people to make decisions for you. You better make sure those people know what the heck they're talking about. So they're guessing that the Fed's not going to raise. That might be true, but it's not factual at this point. So be careful. And how does this scatter plot look to you? Looks like a big circle. Do you know what that means? Mixed. You could summarize it like this. Of the assets we like to consider trading, 50% of them are doing what we'd expect, and the other 50% are doing the opposite. They're doing exactly what we wouldn't expect. Okay. So pound stronger than Swissy, but pound weaker than Aussie and Kiwi. So quite a scatter plot. Kiwi weaker than Swissy, but stronger than yen. Wow. Okay. It's a mess. So don't be gung ho today, according to what's been happening so far today. Remember, this is market forces. So it has nothing to do with economics. This is traders waking up in the morning and dropping their first trades. Right now, it's a bit of a mixed bag. There's no leadership. Should you be a bull or a bear? No. Okay. Now, if you're hell bent on getting some trades in today, the things that are in the unexpected quadrants, top left, bottom right, those are the ones that are out of position and might be trading opportunities for you. Yeah, I got to talk to the developers about this. Here we go. What is the date today? 27th, isn't it? So there you go. Is it the 27th or the 28th? I thought we had GDP today. What's going on in the world? Hang on. It is the 27th. Oh, that's CAD. Yeah, I find this calendar hard to follow. Well, yeah, all of a sudden this is down here. Weird. I need to yell at somebody. Well, that brings me happiness and joy. Nothing like yelling at people to make you feel better about yourself. So, yeah, don't we have GDP today? Not Canadian GDP. Am I wrong? Yeah. Anyways, I don't know why calendar's so difficult, but I'm not a developer, so it's not for me to say. All right, so let's go to the charts. That pound is sort of mixed right now. Here, by the way, these are the longer term trends that we have in place. Aussie is actually quite sideways. Euro is actually quite strong. Uh, dollar, was very weak. Hit the 121.4, bounced, went back to the role reversal, and now is trying to drop back below 100. So we're at 101. And dollar weakness is simply risk on. And we know medium and long term is slightly risk on. Yeah, Andrew, at the live stream today, we'll do that. The press conference for the ECB. Denise says yes, GDP. Yeah, cool. At 8:30. That's what I thought. It's nice to have it in your brain. It'd be nice to have it on the website too, right? Makes it so much easier. Okay. Lagarde's nice. She's classy, but I like Jean-Claude Trichet 20 years ago. He was funny. He's like, I don't know. We will have a glass of wine and a cigarette, and then and then we decide. And he was just so cool about it. He looked like he wanted to party all the time. He's like, man, this job sucks, but the parties are great. Can you imagine having a job which entails you to do nothing for years? We've decided to keep interest rates the same. All right, let's go party. So, anyways, he was funny. That's a terrible French accent, of course, but yeah, I mean, look, these are the longer term charts, right? Like you're like, that's as clear as mud, Wayne. Yeah, yeah, I know. That's the whole point. So we get caught inside these little short moves, but when you back yourself out, what you're trying to find are the solid trends. Yen is quite weak. Now, on the smaller time frames, it comes and goes, and that's because that's normal this time of year, but also yield curve control and the price of the 10-year Japanese government bond, and but in general, that still looks bearish, doesn't it? Um, Dollar is still very risk on. Swiss franc is very much still quite strong. which is good because actually Swiss franc strength means risk off. US dollar weakness means risk on. So you can split the difference. And when it's a risk off day, not let's say not, on the short run, uh, you can buy some Swissy. And then when it's risk on, like the S&P 500 is going up, you can sell some US dollar. You can split it and say, if this, do that. Okay. Are you selling pounds? Are you selling the rip? What do you think of that? So this is a pound index that I've created. Cool. So we've had a 618 Fibonacci retracement. So you look at this and you're probably thinking pound Swissy. Why? The Swissy's strong. If you were going to sell the pound, maybe you'd buy Swissy, pound Swissy. Maybe, right? So then you go to that chart and then you look for technical opportunities. Pound, euro, pound CAD, pound euro, pound Aussie, pound dollar. All right, well, we got to turn one of these into a pissy. All right, let's do pound Aussie. Mhm. Euro Swissy, Aussie Swissy, CAD Swissy. Come on, dude. Kiwi Swissy. Come on, why can't I find it? Euro. Oh, it's actually on it. No wonder. That'll mess me up. Okay. And it's cray oversold, but it makes sense. It should make sense, right? It's a dog with fleas. But we've already kicked off the bottom. This is our sell zone between the averages. And I don't like selling down here. I mean, that's the problem. I don't like doing this. Um, but if you had to do it, an up and then a down would be the right approach. So go into your bias pivots. I really don't like selling here. You know what I like doing? This thing drops all the way down to the gray zone. You take your profit and you go on vacation. Right? And let the amateurs fight the retailers, and I mean the amateurs fight the institutions and stuff like that, and you just get this, like, imagine like nothing actually happened for what, solid 2 weeks. And when I see this, I don't see like really nothing happened. What I see is a great opportunity to lose money because it didn't go up and it didn't go down. So who made money? Probably nobody's happy with this. Another way of looking at it is what we were supposed to do as traders is sell at M3 and target the gray zone. That's the easy money, so to speak. And after that, it's significantly less predictable. So we got to train ourselves, right? And so it's just kind of done. But you could sell in here because it's not bullish. That's the thing. It's never become bullish. Okay. If you were just doing this, you would wait for these two moving averages to cross down. So really moving averages, because these are based on what two different moving averages are doing. But nonetheless, this MACD, if it crossed down, that would give you permission to sell. So if you don't want to look at the pivot point staring you in the face, huh? Put the blinders on and watch this. Now, how would you feel about trading that way? Terrible, huh? Well, if you make money, it'd be the worst thing that would happen to you. Because I think if you did that 5 times in a row, probably 3 to 4 times you'd lose. And it'd take you that long to figure it out to never do it again. So you might win this time and then lose the next 4, 5, 6 times, and then you're like, never again, right? But nonetheless, if you don't use pivot points or something has fundamentally changed, then because these pivot points, this gray zone, this profit taking zone that we're looking at, is based on last month. Well, last month may not describe this month. Okay. So, anyways, wouldn't it be nice to know the seasonality of a pair like pound Swissy? You're like, but you're like, Wayne, nobody has that kind of information. Oh, okay. We can take a look. Oh. Okay. Typically, this pair in the period between July to August and August to September and September to October and October to November. Okay. Typically, it starts going up. Now we're looking at in years past, this April, May, June period have been down. And in that period, what actually happened this year was up. So it was out of position. It was late and then finally caught the move down, which usually happened anyways. It was just delayed a few weeks. Okay. You can see it finally did collapse. And so right now it shows everything down, 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 down. Okay. But maybe we could read this and interpret it like the market was a little late on the downward move for whatever reason. But we just know April, May, June, usually over 5 years and 20 years, usually is down, and it was up and then down. And that maybe in the next, what, 4 to 6 to 8 weeks, the downward move ends. Is that a fair way to read this? Well, then, if the answer to that is yes, then this scares the bejesus out of me to sell because it might fall. Um, but I think it's interesting to know the last 5 years and the last 20 years, it should be going up. Well, what if it double bottoms and then starts going up? Okay. And by the way, that's risk on. And that means people are not fleeing London and stuffing their Swiss bank accounts full of money, particular Great British pound. Okay. So if everything is right as rain, maybe now's the time to buy some nice real estate in London, huh? Nothing too ostentatious, something simple. I once had the opportunity to spend the weekend in Margaret Thatcher's old apartment building overlooking the Thames. And then I found out the pound was 2.5 pounds to the dollar. So let me translate that to English. If it's £1,000 a night, it's going to cost you $2,500 a night. And you're like, yeah, let me think about it. No, changed my mind. Yeah. I mean, it's also funny, right? Like, hey, this is Wayne McDonald's old college dorm room. I'm going to spend $3,000 a night. You're like, no, you probably don't. Not that important. All right. So, anyways, down, 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 down. This trade is coming back together, huh? It's trying. This is an old currency trade, a hedge fund that I've been doing some consulting with. They put this trade together. I like what we do. All of this is one trade, by the way. Amazing, right? You're like, complicated. What do you think? Do we have an inverse head and shoulders? So on one of them, pound Swissy, we're thinking pound strength. Well, I'd like to see Swiss franc weakness, really, for risk on. And then if this goes up, if this is an inverse head and shoulders, then you're like, but dude, then that makes pound weak. Well, to thread this string of pearls a little better, if there's risk on, the US dollar is weak. If the US dollar is weak, the euro will go up. If the euro goes up, it'll probably overpower the pound. And maybe, just maybe, we get inside this long term range again, where we fart around sort of 87 to 89. Yeah, seems reasonable, huh? Okay. This particular trade, if you stay in the middle between the upper bound and the lower bound, you get paid once a week. If you're between the lines on the bottom, you don't get paid, but you don't lose money. If you're below or you're above, you need to go to the cash market because these are options. You got to go to the cash market and hedge like crazy because you're actually losing on this position. So then, if you were down here, you would sell euro pound in the cash market, leveraged 100 to 1, because this isn't leveraged, really. I mean, kind of is, kind of isn't. Uh, so interesting. I kind of like what we do. Okay. Pound Swissy, nonetheless, quite bearish. Here's that range trade. My recommendation is if you're going to sell it as high as possible. If you're going to buy it as low as possible. And when it's in between, do nothing. And it should work out just like this. If you've sold it high, you're okay. If you bought it low, you'll be okay and you don't sweat bullets in the middle. It's when you're in the middle, when you trade in the middle, you have to fight the bulls and the bears. Yeah. You have no allies, huh? Nobody helping your trade out at all. I call that nomad's land. Huh? Bullets flying left and right. I've heard the Ukraine war is turned into a World War One where they're all entrenched now. Trenches and trenches and trenches and more trenches. So now the drones just go over and drop the bombs. Because that was the thing with World War One. You'd send out artillery, bomb the other side for an hour, and never hit anybody. Because you'd have to have it land directly in the trench, like which is nearly impossible. Statistically, it's impossible. So, anyways, with the drones, You just fly over. So Andrew's like peso open interest increased 100. Yeah. Yeah. I'm still on that, Andrew. I've been short euro peso on this account since February. Let me bring it up. I was just looking at it yesterday. Here we go. I gotta bring it up. How do I pull this up? Yes, I sold USD Mexican peso on February 13th at 5:46 a.m. Yeah. And so and I know institutional traders are on these trades. So it's one of the things we talk about. I'll show you. I don't know. I know you can. Oh, my webcam's not even working again. I guess I need to reboot or not reboot. Yeah, I guess you can't see. Anyways, on one standard lot, I've made $1,846.33 in swap, which is pretty good because I only have $1,000 of real cash risked. So I'm up 185% on the money I've risked. Cool. So I'm on my way to making 200% on interest, but I'm up 11,000. I think that's total. I don't have the actual pip. So you got to take 2011. So I'm up $9,000 in pips, in $2,000 in interest, and I've only invested 1,000. So 10x, 1,000% return on investment since February. So that's why institutional investors would be on that. Amazing, huh? Oh, if I only risked my entire retirement account on that, then I'd be rich. Once. Then I'd be living in a cardboard box behind the Starbucks, g- eating bagels out of a garbage can. I used to be a currency trader. It's a tough gig. hmm So, anyways, quickly looking at commodities, and I think we'll call it a day. I think we're going to have inflation in the future. I think everything that has been going good right now is going to fall apart. Does anybody else have that sort of sense that the Fed comes out and they're like, we've jacked up interest rates high enough? Well, the problem is the economy hasn't slowed down. The only thing they've achieved is inflation has fallen from 10% to 4%. Okay, good. Did that have anything to do with grain and fuel prices coming down? Well, that's the only thing that happened. So they're like, job well done, everybody. Inflation's tamed. I'm like, well, as far as I know, we still have $5 trillion floating around there that the Fed can't remove. The federal government needs to raise taxes and pay back $5 trillion in deficit. That's what needs to happen. We know that that ain't going to happen. So we're going to have persistent inflation and no one's losing their job. Earnings seem to be great. Facebook's making money, Google's making money, that kind of stuff. Like, it doesn't feel like the end of the world. No one's lost their job yet, statistically speaking. You're like, but my cousin Billy. Well, okay, your cousin Billy lost his job. All right. But statistically speaking, I went through all the data and I've been going through all the data on these quarterly outlooks I've been doing. And the second part of the recession, that's the second part that's required for a recession, hasn't occurred yet. So I would argue with the Fed and say, Look, I have a feeling you've jacked up interest rates from 0 to 5% and above, and inflation has fallen. But I kind of think that has something to do with the supply chain going back to normal after COVID. I also kind of think it has a lot to do with the Biden administration flooding the global market for energy with oil that is supposed to be in reserve just in case a rainy day, a tragedy strikes, war strikes, something happens, and we need that energy. But we've been dumping it on the market to bring down prices. Okay, okay, okay. And we said we'd stop that. By the way, it's been 13 or 14 weeks in a row where we're still pulling from the Strategic Petroleum Reserve. But I would argue that maybe interest rates went from 0 to 5 something, but it actually hasn't brought down inflation. Wage inflation's still there, rent inflation's still there, but gold has dropped, oil has dropped, grains have dropped. Great. So what is the Fed going to do for us if suddenly grain prices and oil prices go back up? Well, then we have inflation again. Yeah. I'm worried about that. I think that's a realistic scenario. And when you're staring at, remember like a month ago, oil was at 65. Now it's at 80, on its way to 100, maybe. That's a problem, isn't it? That smells like inflation to me. So, anyways, if food prices go up, mm, mm, I filled my wife's BMW up with gas. It's it's got a sewing machine engine in it. It gets 40 miles to the gallon, and it's turbocharged, so it sounds terrible, but I think it's like a 1.8 liter engine. Like back in the day, your lawnmower had a 1.8 liter engine. Um, this thing will go, and it gets good gas mileage, so it's actually an amazing engineering feat. But let me just say, you have to get out of the vehicle to change your mind because it's so tiny inside, right? And I filled up with gas, and it was $66.66 for a golf cart, gas powered BMW golf cart. Uh, it wasn't cheap. I got to tell my daughter, I'm like, "Huh, you're saving money so you can put gas in your car, right? Look at what it costs. Take you a month to earn that kind of money." Like, yeah, it's expensive. So, anyways, wowzer, it doesn't seem cheap in the moment. So, uh, uh, I'm not. It's like how do you say this? It's not a prediction, but it's likely, isn't it? And therefore, you need to be ready to adjust your portfolio in a way that everything feels good right now. The stock market's up, the Fed's done, we're saved. Recession over, everybody. All those recession fears, don't worry about it. I think that market sentiment could possibly change very quickly. So don't act like it will, but if it does, be ready to switch teams. So be a bull, be risk on. The market's going up, love it. Love it. Remember, 90 what 8% of people benefit from the stock market going up. So you can high five your neighbor and everything. Hey, awesome, free money. Yeah, free money. And then watch them I don't know, do silly things with their money because they think they're rich again. Uh-oh. So be prepared more than everybody else for a change in direction. But right now it seems risk on. QuantBox will tell you that. It's nice to have a tool that can just help you decide. I mean, you may never have actually followed the VIX before. Okay. And VIX is falling right now, which means fear is going away. VIX has to do with people buying options on the S&P 500 because they're afraid the S&P 500 is going to fall, and they don't want to get out of their cash position because they're like, man, I built a really good portfolio. I'm afraid it's going to come down, that it'll fall for 1 or 2 months, but I want to be in this position, for years. So I guess I'll throw down an option, right? I'll buy a put and protect myself so that if the stock market does fall, I'll make money on my option, but I'm losing money in the cash. So the money that I earned from the option offsets the money I've lost in the cash position. And then eventually it goes bullish again. And you're right as rain. This shows VIX is falling. Over the month, down 10%. Over the week, down 8%. Over the day, almost 2%. So just from yesterday, there's been a big move. That means people, in this case, institutional investors, because I doubt retail traders are doing this. So institutional traders are like, they're not worried about the stock market falling right now. Risk on. Dollars weak, risk on. Okay. S&P 500 is up, risk on. Okay. So anyways, it's nice to have a gauge to kind of help you organize your thoughts. Okay. Now, Andrew had questions about peso. You're talking about you want peso on our COT report, Smart Money Tracker. It sounds easy enough. Just imagine you have to pay money to get the data and then organize it in tables and then pull it from the CFTC every Friday and get it on here. It's not that easy, but the answer is maybe. Okay. All right. So I'll let you to it. I went too long today. I apologize for that. So we do have important news today. The ECB press conference starting momentarily. GDP in the United States of America, but remember it's backward looking. But it's nice to update our intel so that we can make informed decisions. Okay. So cool. Peace on earth. May the pips be with you. May our profits be above average. I know my camera's off, but I'm throwing the peace sign. Right? Or hailing a taxi cab. Isn't that ironic? No, it's not ironic. All right. So see you later. Cheers.